Hey, Carl. When we look at valuations, I think there's a couple of simple measures to look at. One is something like median market PE, so that the median stock in the S&P, and that multiple's 16 and a half times forward earnings now. It was almost 20 times at the end of 2019. So the stock market, even though we're 2 years or 3 years really almost past the pandemic start, the multiples actually declined. And in terms of free cash yield, it's the same story, that free cash flow yield on the median stock now is 5.8%. The 10 years under 2%. So you're still getting paid a pretty hefty premium to own equity. So I know stocks are kind of in no man's land because of a lot of uncertainty, including the war and this sort of surge in inflation. But the fact that the market valuations aren't causing you to have a huge margin of error on the downside means, I just think you can't really get that hurt if you buy stocks here over the next 12 months.
Right. You're beginning to spin out a bit of a narrative. I mean, Yellen's on the tape right now talking about whether or not there's a path for further sanctions given the horrible offensive we saw yesterday. It does sound, though, that you're beginning to hear from world leaders the limits of sanctions because of the collateral damage. Am I right?
That's right. What's pretty apparent now is that the sanctions have caused oil to spike and commodity prices to spike. So it's now delivering a pretty big blow to the rest of the world. So even anyone outside the conflict is now paying the price because food and energy has gotten expensive. So it just shows you the sanctions are essentially becoming a game of relative pain. Is Russia going to suffer more pain than the rest of the world? But I'm not sure it's a great strategy to actually continue to add sanctions that cause further inflationary pressures.
Hey, Tom, it's Deirdre. Good morning. You've seen a number of hedge funds increase their cash positions. Are you, despite sort of a 7% annualized rate of inflation, is this a smart move for the average investor?
I think the foundation for the bull market is still intact. I'd say the best sort of harbinger of that is the yield curve has been steepening to 10-year versus 30, even the 2s versus 10. And if that's the case, then what we're really experiencing, even with inflation, is a spike in commodities that are now working its way through the system. And it's as painful as it is very different than being in a secular structural inflation problem. And so, I think it's painful now. Even today's CPI report, as you guys just mentioned, one of the sort of glimmers is that used car prices, which was over half of that rise in CPI last year, is starting to decline. So things that were, viewed as sort of enormous risk to the market in terms of continuing to add pressure are diminishing. And that could be the case for CPI really over the next 12 months.
So, Tom, do you hold on to more cash?
Well, I think we are in a no man's land for the moment. Our base case for first half 2022 was that markets would be treacherous. This is far more treacherous than we expected. And I think it's, of course, because we're in wartime conditions. But do I think stocks will end higher from here on an absolute basis? Yes. I think even though we're at S&P 4,200, I think we could still exit this year with 5,100 or higher.
Hey, Tom, you mentioned CPI. If Bitcoin is an inflation hedge, then why isn't it trading like one?
Ja, that's a great question. So there's two ways to answer that. One is, of course, it's not a great hedge because we have inflation. Or the other is Bitcoin doesn't actually see inflation in the U.S. I think that's what we'll know in 12 months. But it's, of course, been a great inflation hedge for people who live in countries that have had huge devaluations. Whether it's the Ukraine, Venezuela, Turkey, even those who own Bitcoin in Russia, they've really been shielded from the devaluation of the currency, which is essentially the core of why they're seeing inflation.
But I guess it'd be even better if they could get dollars. So I guess that being the case, what is your expectation on the role that Bitcoin and cryptocurrencies play going forward, particularly in light of the executive order that we got yesterday, which, of course, lays out the questions to be asked more than the answers?
Yes, that's right. I'd say that the biggest I think the most important way to look at this is compare this to 5 years ago when anyone would have said Bitcoin is, is just a piece of code or just, it's a bubble or, it's a pure source of speculation. And today it's becoming something that even the U.S. policy Treasury Department has to figure out. I think it just shows you that crypto is solving some real problems. And I think the usefulness, especially outside the U.S., has actually been proven, especially during this conflict. So I think it's actually ultimately all good things happening.
Hey, finally, Tom, having done so much good high-frequency work on COVID throughout the pandemic, it's amazing how much we are not talking about it lately. I see the CDC is going to devise some guidelines. We might drop masks on public transit next month. Are you putting all of that data work in a drawer, or do you expect to revisit it later on?
It's a great question. I think the best case would be for COVID to disappear, similar to other pandemics. And if that's the case, that would be a great outcome. We're still compiling the data. And I'd say that we'll have a better sense because, really the last place where COVID is sort of, raging is actually the Far East. And once that's done, if there's no new variant, we could really, hopefully just table the whole thing, like you said.
It would be amazing. You definitely kept us so well informed for a couple of years, and we're hoping we don't have to go back to that data stuff. Tom, thanks. We'll talk soon. Tom Lee.
Thank you.